It's a shortened trading week on Wall Street. Joining us now to preview what to expect is Matt Stucky, Vice President, Chief Portfolio Manager of Equities at Northwestern Mutual. Matt, thanks so much for joining us.
Well, good morning. Thanks for having me, Caroline.
So, Matt, let's start with your view on the market. It's really sending mixed signals right now. The Dow is near highs, although has already erased early gains. Tech is wobbling. Money is rotating. What's the story beneath the surface right now?
Well, underneath the surface, there is a lot of rotation happening within the market. Certainly, technology being the forefront of that, being the leader in 2023, 2024, and most of 2025. But as the economy has started to show signs of broadening out, you're seeing other asset class leadership within markets underneath the surface. And so things like industrials are doing quite well, small cap stocks doing pretty well. And it's leading to investors to contemplate, what's changing underneath the surface. And I think if we're taking a step back and looking at the driver of that, it's really the interest rate environment's shifting. We're in the rearview mirror. We have a few federal rate cuts, and the prospect of additional cuts in 2026 looks promising. And so companies that were harmed by interest rates moving higher from 2022 through 2024 are starting to see the benefits of a more favorable interest rate environment. Specifically, I would say, small cap stocks being the forefront of that benefit. So that's causing some rotation just from a macroeconomic perspective. But additionally, investors are having heightened anxiety about kind of what's happening in terms of the potential disruption from artificial intelligence. And when you're looking at the S&P 500 specifically, it's a concentrated index. And so the amount of volatility underneath the surface, I think, is magnified because of that. And look no further than technology stocks. It's kind of being kind of where that disruption anxiety is most heightened at the moment.
Okay, so let's break that all down. As you said, we're seeing money rotate into small and mid caps. Is that healthy broadening, or is it the early stages of leadership cracking?
That's a really good question. I think it's healthy broadening at this point. The more that we see additional breadth, participation, and ongoing uptrends in different segments of the market, the healthier the market is. And just to take a step back and look at kind of how narrow the market was over the last few years, between 20 and 30% of S&P 500 companies outperformed the S&P 500 in 2023 through 2025. That's historically narrow. Typically, the range is between 40 and 50%. If you go back from late fall through the end of January, that percentage ticked up to almost 60%. And so that broadening out, from my perspective, is a healthy sign. The question is does it leave some risk from an ongoing perspective to some of the weightier components of the S&P 500, names that potentially could either benefit or be harmed from the adoption of artificial intelligence? We'll have to wait and see on that. But certainly, if we're looking at the overall kind of context of kind of what's moving higher and what's dragging lower, there is more positives than negatives. It's just those chunkier pieces are causing a lot of volatility underneath the surface of the market.
Okay, so still a question mark around tech, but you mentioned industrials. We've also seen a lot of strength in energy, materials, staples. Will that leadership continue, do you think, or do you think those are just temporary hiding spots for kind of this nervous money right now?
I think it's natural to see some of those defensive parts of the market, namely consumer staples, healthcare, potentially getting a bid just from a flight to safety dynamic as money rotates away from the concentrated profile of the S&P 500 to more defensive parts of the market. Certainly still in the S&P 500 for a lot of those components, but much smaller in terms of their weight today than just a few years ago. I think if you're looking forward and saying, okay, what would keep this rotation intact? There's a few things. One is we need to continue to see earnings revisions up and to the right for those segments of the market that really haven't been leading the market higher. If you're looking over the last few years, that did change back in mid-May of 2025. You started to see finally the fundamental strength of things like small caps, mid caps, equal weight S&P start to rise in terms of earnings expectations. It's no longer just the only source of earnings growth is technology, and really kind of being the driver there of that concentrated return profile we've seen for the last few years. So for this to continue, you need to see continued earnings revisions up and to the right. for those other segments of the market that are currently leading. And we're starting to continue to see that. We're just kind of finishing up earnings season in the fourth quarter, and it was fairly healthy. Top line growth healthy, and bottom line growth north of 12% or so, kind of building on the strength that you saw in the second and the third quarter. But again, just to underline the point, it's been a broader story in terms of where that earnings growth is coming from versus just a narrow subset of the market.
Okay, so as chief portfolio manager, I'm curious about what you're doing with your portfolios. Are you getting defensive right here, like we're seeing the broader market do, or are you staying the course with growth?
We're not changing our process just in terms of how we select securities. We actually tend to run our portfolios fairly sector neutral relative to the benchmarks we're managing against. And so we don't really tend to pick spots. Are we going to get more defensive by loading up in staples or more aggressive by loading up in tech? What we're looking to maximize is within each sector, what are we getting in terms of the price we're paying? And so there's a relative value component to what we look for. There's an ongoing business momentum and quality component that we're always looking to maximize. And right now, I would say if you're looking for different areas of opportunity, there are just more attractive securities across every sector of the market, again, because the fundamentals are starting to inflect across broader segments of the economy. And that means if you're a portfolio manager, it's more of a target-rich environment. If you look at different sectors of the portfolio versus just really seeing that attractive fundamental story within technology, which I would say continues to be the case. But it's just not the only story in town, which is just kind of leading on to this additional rotation. And so to me, it's a more optimistic tone, I would say, in terms of looking at the portfolio today and seeing kind of more attractive stories in different segments of the economy and different segments of the market. But nothing changing in terms of the ongoing philosophy of how we're managing money.
Okay, so tell me about some of those attractive opportunities that you're finding right now in terms of individual names.
Well, I think taking a longer term view right now, as there's a lot of knee-jerk AI disruption concerns that are out there, I think it's really interesting to look at financials at the current moment. This is a highly regulated industry in terms of the regulatory bodies underlying who can do business with who, and ongoing kind of capital ratios and things of that nature. And so if you're looking at who's likely to be more of a beneficiary of artificial intelligence in terms of productivity versus more of a potential disrupted entity, I would think financials are more insulated from that risk versus other segments. And so specifically, if you're looking at the banks, right now there's a really strong story going on in terms of the capital market cycle and some of those fee-based businesses for large money centers. But additionally, if you're looking at the productivity side, artificial intelligence is good at a few things. If it's able to get to the right answer on repeated tasks, and there's enough context window, we can start to replicate a lot of back office workflows through artificial intelligence and create kind of more efficiencies in terms of those businesses within the financial services area. And so to me, I think that's a good cost saves and a productivity enhancement to generating higher returns on tangible equity for a lot of financial institutions that are out there. And at least that opportunity set to me seems pretty strong relative to the risk of disruption. And so those areas to me within the financial services arena, to me, maybe you push back a little bit on some of the lowered sentiment that we saw last week in that space.
Okay. So speaking of financials, I see JP Morgan, Goldman Sachs, I see Capital One as some of your top holdings. But if I take a look at that list, I see NVIDIA, Microsoft, Alphabet, Apple, Amazon, Meta. So would you classify those as holds right now? Or would you advise people to buy these dips that we've been seeing, because all of the Mag 7 are negative so far in 2026?
Yeah, it's really interesting. We've seen a good amount of multiple compression in the Mag 7 names to start this year. It could be fears about potential disruption risk. It could be fears that these companies are spending too much money. It could be a combination of those things. And I think if you look at the results of an Amazon or a Google specifically, those those concerns are about more of the, are we spending too much? But if you look at what they've been saying the last few quarters, is they're continuing trying to catch up to kind of where their demand profile is within their cloud computing businesses relative to the resources they have stacked within those businesses. And so to me, when I see a headline from Amazon or a headline from Google in the latest earnings reports that they're going to really be aggressive in terms of capital spending, to me, I think they're pressing their advantage in terms of their ability to procure compute resources over the next 12 months relative to the rest of the competition, and then to profitably put that capacity in place to sell out and grow their businesses. To me, I think is an attractive investment if you're in the C-suite of those businesses. Now, the caveat to that is that those elevated capex profiles, even though they can afford to pay them through cash flow, are going to require them to potentially maybe lower shareholder distributions in the form of buybacks, or at least water them down a little bit in 2026. But to me, if you're a longer term shareholder, I'd rather them reinvest in their business and grow those businesses, because the ROI on that level of investment is more attractive than just simply doing a share buyback. The other names that you mentioned specifically, Capital One, Goldman Sachs, JP Morgan, to me, we talked about how the cost takeout potential of artificial intelligence is more of a benefit in my view versus the potential disruption risk. I think that's true, and if we're looking at those names specifically, you're always going to be concerned about a credit cycle, but we're just not seeing that in data. And with some fairly I would say steady credit performance, that area of risk relative to kind of the risks of financials that you typically think about, to me seems fairly benign at this point. So to me, I think you got to go case by case with each one of these holdings in terms of how the market environment's treating these names. But to me, there's a lot of optimism, I would say, I would still have in all of those positions.
Okay, Matt, we're just about done with the interview, but before we actually let you go, we want to do a rapid fire game of this or that. This is your first time playing with us, so just so you know, quick answers, otherwise I'm going to cut you off. You ready to play?
Let's do it.
All right, overweight or underweight tech?
I would go slightly overweight, lean into a little bit of the negative sentiment here.
Okay, Mag 7 or broader tech?
Broader tech. I think concentration to me, I think is a little bit where you want to push back against.
Okay, we're keeping these quick. Software or semis?
Continue with semis.
Semis or cybersecurity?
Still semis.
Buy the dip or wait for confirmation?
Wait for confirmation.
Broadening it out. Small caps or mega caps?
Small caps.
US or international?
International.
Quality or momentum?
Quality.
Buy and hold the S&P or selective stock picking?
Buy and hold at this point.
Income focus or growth focus?
Income.
Cash on the sidelines or fully invested?
Fully invested.
Consumer staples or discretionary?
Discretionary.
That being said, Walmart on tap to report earnings this week. Walmart or Target?
Walmart, but that one you got to twist my arm.
Okay, Walmart or Costco?
Costco.
Both top picks, JP Morgan or Goldman Sachs?
JP.
Other top picks, Visa or Capital One?
Cap One.
Capital One or MasterCard?
Capital One.
Gold or silver?
Gold.
Gold or Bitcoin?
Gold.
One sentence to describe how you're feeling about the current market.
Optimistic.
So by year end, this is a market that will be higher or lower than where we are now?
Higher.
Single digit returns, double digit returns, what do you think?
Single digit.
All right. We'll leave it there. Matt Stucky, really appreciate you joining us. Thanks so much.
Thanks for having me.
That's Matt Stucky, Vice President, Chief Portfolio Manager, Equities at Northwestern Mutual.